During the call, the CEO mentioned a lot, 2 gigawatts, 2 gigawatts, 2 gigawatts. And I think that's what, I wasn't able to verify this, but I'm from what I can infer, he was referring to the contracts that they were signing, that the hyperscalers were requesting, that they needed 2 gigawatts of sustained power. And so to put that in perspective, like we're throwing our own numbers, you're like, oh, what does that mean? 2 gigawatts, that doesn't sound like that much.
Love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks, welcome to Investing for Beginners podcast. Today, we're going to do a bird's eye view. And the company that we're going to pick for today is GE Vernova. This is the ticker is GEV. But before we dive in today, we'd love to hear from you. So we are running a listener survey, and everyone who participates gets entered into a raffle for a $500 Amazon gift card. Plus, the first 100 people to respond will receive a free Investing for Beginners coffee cup and coaster set. So head over to einvestingforbeginners.com/pod survey. That also will be in the show notes. Your feedback will help make the show a lot better, and we'd appreciate you taking a few minutes to share your thoughts. Again, that's einvestingforbeginners.com/pod survey. Must be 18 or older to fill out the survey, and terms and conditions will apply. All right. So with that, let's talk about a bird's eye view of GE Vernova. So Andrew is going to act as the interviewer, and I'm going to attempt to be the expert on this company today.
Well, you've done, 1,000x or 1,000,000x or infinity more work than I've done on this company. So I will happily sit on this seat and you sit on that seat.
All right.
Might be a little bit better for listeners. So, all right. GE Vernova. I'm sure a lot of us have heard about GE, maybe haven't heard that second part. So who are they and what do they do? How do they make money? Stuff like that.
Yeah. So GE Vernova is a spinoff from General Electric, or GE. So the company was spun off in 2021 and it became a public company at that time. The company GE actually split into 3 different parts. So now there's a GE Healthcare, GE Vernova, who we're going to talk about today, and GE Aerospace. So General Electric was one of the blue chip stocks for many, many, many years, and had fallen on hard times, had started to recover, and they decided to split off the different segments. So now GE Vernova is a kind of a separate standalone company. So their company mission, according to the CEO, yesterday I listened to their latest investor presentation, which was done in December. So their company mission, air quote, is the energy to change the world. So that all sounds fantastic and a little bit woo-woo. But what does that really mean? So GE Vernova they're a global energy equipment manufacturer who are building products and services kind of across the entire electric value chain. And so they basically help people generate electricity, transmit power across grids, store the electricity, and they're also helping modernize the aging infrastructure. So that's kind of the basic gist of what they do. The main, they operate in 3 segments. So we'll talk about these a little bit more, but the main thing that they do is they help generate power for the AI, the AI data centers. They're also helping modernize the grid. So our electrical grid is probably overdue for some updating is a massive understatement. A lot of the transmission lines and transformers and everything that we're using currently today are probably 30 or 40 years past when they need to be updated. So this is long overdue. And then they are also helping transfer the power. So, and we'll talk about all those as we kind of go along. So maybe we could talk about the business segments first.
Yeah, I was curious. So you said 3 segments. Which one catches your eye first, and why did it catch your eye? And then what is it and all that?
Yeah, so they operate in three segments. So they have the electrification segment, they have the wind segment, and then they have the power segment. So we'll just kind of walk through all of these. The one that gets the most press is the power segment. This is the one that is connected the closest to AI, and this is the one that has the gas turbines that they're making, the nuclear power, the small modular reactors, and also the long-term contracts that they're working out with the government. That's the one that gets the most press. The one that I'm actually the most excited about is the electrification segment, and this is one is growing the fastest. So this is about 25% of the revenue, give or take, and it's also growing the fastest. It's got about 25% organic revenue growth in 2025. The other segments are growing a little bit slower. So what the electrification segment does is this is the grid solutions part of it. So they're building out transformers, switchgear, and other power conversion equipment, and they're helping automate and, I guess, digitalize the grid. And this is the part that is most overdue and probably has the longest runway for them right now, because as the CEO said yesterday in the call that I listened to, this is going to be the longest running part of their business, because there is so much growth available, and there's not a lot of companies out there that can do this on the scale that GE Vernova can do. And so that gives them a definite leg up. For those unfamiliar with our grid segment, if you will, it's very fragmented, to say the least. And there's lots of little different islands. So I think there's three main segments of infrastructure here in the United States. But among those three, there's a lot of different players that are all contributing to different parts of the segment. So utilities, for example. So like I live in North Carolina, so I pay Duke Energy every month. Duke Energy is responsible for updating and maintaining the lines and the transformers and all the equipment that they operate on, but there's also an overarching grid that all connects to. And so what GE Vernova is doing is they are working with Duke Energy to help them update this stuff. So Duke Energy doesn't actually do it. They contract out to companies like GE Vernova and NextEra Energy and others to help them update these systems. And so that's what GE Vernova is the most excited about, and that's what they're working on the most. So this, you're going to hear this a lot if you listen to any calls with GE Vernova. A lot of the discussion is around their backlog. And we'll get to that here in a power one in just a minute. But the equipment backlog for the electrification right now it grew 6.5 billion for the year, and right now it's sitting at $26 billion for equipment backlog. And so what that means is that GE Vernova has 26 billion in projected revenue from once they execute the contracts that they have signed that could generate revenue for this company. And these contracts are long dated, so these aren't things that they're completing next week. They can take years to fulfill. And so this is where the company has the longest runway, is what the CEO was telling me. So that's probably the one that I'm most excited about. This is the air quote star performer of the business. Mm-hmm. Again, the company is growing revenues right now about 7 or 9% overall, but this segment is growing around 25%. And it's about a quarter of the revenues right now for the company.
That's super helpful context, but incredible backlog. So as a former investor in defense stocks, I remember book to bill is kind of a metric where you can compare revenues to backlog. Book to bill, I think they were saying like if it's over a 1, then that means you have an exciting backlog and you're probably going to get some really nice growth. What were the numbers again? It was 26 backlog.
26 billion in backlog just for that particular segment alone.
And they're doing revenues of like a tenth of that.
It's right. They're hovering around between 8 to 9 billion annually right now.
Okay, that's insane. So it's like,
yeah.
I mean, I don't have the formula in front of me, but book to bill, I would imagine over 2.5. Yeah, that's crazy. Yeah. Okay. Yeah. So like, needless to say, like if you are interested in GE Vernova, you should get your background about the grid and how it works in the United States. So on that, I will say, back in 2022, we had Adrian come on our show, and he did a bird's eye view of Brookfield Asset Management. And so if you're looking for more information after we're done here, go to Investing for Beginners podcast Brookfield. That episode should show up, and you'll get more background on the electric grid and yeah, more information about that. It's always better. So, okay. You mentioned the backlog for equipment. Where does that rabbit trail lead you next?
The next, I guess, was looking at the power segment. That was the other thing that I was kind of most curious about, because this is the part that gets the most press. If you go on social media, if you look at what the company, I guess, pumps up the most, it's the connection to AI. And so what's happening is that a lot of these hyperscalers and data centers need power. There's a huge demand for power for the needs of these data centers. And so what's happening is that a company like GE Vernova can produce fairly quickly these gas turbines that can provide these data centers and the hyperscalers with consistent, stable power. One of the drawbacks to renewables is that they are not consistent. The sun doesn't shine, the wind doesn't blow. It just makes it harder. They also have a much smaller footprint. So to put a gas turbine is a much smaller footprint than building out a solar farm that you need to power the data centers. And so I don't have the numbers for the data centers. I wasn't able to get those for the power that they need. But one of the things that I did learn was each of these gas turbines can produce anywhere from 400 to 600 megawatts of power, sustained power, depending on the size of the unit and how quickly the gas turbines turn. And so depending on what the needs are for each individual data center, for example, will have a bearing on how many gas turbines they need to install, or the hyperscalers, for that matter, the same. So just to kind of put all this in context, there was during the call, the CEO mentioned a lot, 2 gigawatts, 2 gigawatts, 2 gigawatts. And I think that's what, I wasn't able to verify this, but I'm from what I can infer, he was referring to the contracts that they were signing, that the hyperscalers were requesting, that they needed 2 gigawatts of sustained power. And so to put that in perspective, like, we're throwing our own numbers, you're like, oh, what does that mean? 2 gigawatts, that doesn't sound like that much. To put it in perspective, the CEO mentioned this little tidbit. The city of New Orleans uses their peak average usage of power daily is 2 gigawatts a day. So the city of New Orleans uses on a steady state 2 gigawatts of power a day. And this is what these hyperscalers are looking to use to power their data centers. And that's what they're trying to build out. GE Vernova is trying to build out for these companies. So to put that in perspective, New York City, I believe, is running around 15 gigawatts of power daily. That is what their sustained is. So GE Vernova right now has a backlog of gas turbines to be built of 80 gigawatts. So that is, so think about that. That's 40 cities of New Orleans. They have a backlog to build these gas turbines. So
Dang.
It's huge.
That's massive. And my mind goes to, okay, that's a lot of runway. That's a lot of cities to conquer, if you will, of like this story could just be getting started.
Yeah. Yes, very, very much so. And that is exactly the story that the CEO was telling, was that this is just starting. The company is right now, they're at full capacity to build out the gas turbines to 2028. And they are still booking contracts for beyond. And they're also building out capacity to try to be able to produce more of these gas turbines. So when we're talking about these gas turbines, just to kind of make this a little more tangible for people, they're basically jet engines. It's really what they are. They're jet engines. So they have turbines that turn really fast, and then they inject so it puts out an exhaust as it the turbines put out, and then they inject natural gas into that exhaust, which ignites, which causes steam to be produced, and that's what turns the turbines and creates the electric energy for these machines. So they're basically building gas, and they're basically building jet engines. I read something on Twitter a few days ago where one of the engineers was saying, "Yeah, we basically build jet engines."
That's cool. Do you know, like, is it similar to HVAC systems? We're investors in a HVAC distributor, and I know with those, like, they're getting a little bit better every year. Obviously, if you've ever owned a home, you have to replace your HVAC every however many years. But like, the big thing is, like, for HVACs, as they get more efficient over the years, that price goes higher. And so it's like a very long-term revenue stream. Do you know if that's the case, or is that something we can dive into at a future point?
We could. They alluded to some of that. One of the things that they mentioned several times in the earnings calls and things that I listened to yesterday was that they are seeing a volume increase. So the request for more engines, but they're also seeing because there's so much demand, they're also seeing a pricing increasing in the units that they're using. Now, they did mention a couple of units that they have in Europe, in France, that are much older units that are far less efficient than the machines that they are building right now. So those older machines, he said, are probably producing energy around a 40% efficiency output rate, whereas the new machines are putting out around 60% efficiency, give or take.
Wow.
The machines, and they're constantly working on trying to improve that. The other part of this that I haven't mentioned is the small modular reactions, reactors. So nuclear reactors. They're also building out SMRs. And this is another request from the hyperscalers and the data centers in the ability to try to get sustained power. And these are they are building these out as well. They have a unit that's being worked on right now in Canada, and then they have a few other ones that they're doing site selection and things like that. This takes a lot longer because of the regulations that are surround building anything nuclear. It just takes longer. So, but this is another part of that power segment that they talked a little bit about as well. So this is something that's going to be growing part of their business as well.
Okay, cool. Anything else you think we need to cover about why people are excited? That's a pretty promising future, I would say.
Yeah, right. Yeah, it really is. One thing I probably should mention just briefly that's a little bit of maybe not a downer, but is not a positive for the business is the wind turbines. So they are the leading producer of wind turbines in the United States and maybe even globally. And they have that segment of the business has been on the struggle bus. Revenues have been pretty slow. It hasn't been as profitable as they expected. And they also mentioned that orders for the turbines have been much, much slower, particularly for land usage. Offshore has been steadier for them, but onshore wind farms or wind towers have been much, much slower, the orders for those. Some of that is just because of the nature of the requirements to build them, the land that's needed to build them, and just the inefficiency of using the towers. So that hasn't been a great part of their business. So there is something to, so it's not all sunshine and roses, I guess.
Yeah. Or very rarely is, right?
Right.
Do you think some of that's affected by some of the government funding towards renewables?
Oh yeah, unquestionably. Okay. Yeah, unquestionably. They mentioned, that they are working closely with the government on like the gas turbines, the SMRs, and the grid electrification. So they didn't really mention the government so much with the wind turbines, but you got to think that it's certainly connected.
Yeah, makes sense. All right, let's get to my favorite part of an episode like this. Give me some numbers. Let's go.
Okay. All right. All right. Let's go. All right. So, if we kind of take a look at the income statement, so a couple things that'll probably jump out. Number one is, everybody's super excited about a business, but if you look at the revenue growth, it's good, but it's not hyperscaler. It's not, it's not these super, growth companies. It's, they're growing around, 5 or 6% a year. Last year, or the last 12 months, it's according to fiscal.ai, it's 9.4%. Last year in 2024, it was 5.1, 2023, 12.1. So, these are not huge numbers by any stretch of imagination. I mean, it's producing a lot of revenue. Just to put it in context, it's 37.6 billion in revenue in the last 12 months, which is on par with what Visa does annually. So just to kind of put it in perspective, it's it's doing good numbers. The company is profitable on a gross profit margin and on an operating margin level, as well as net income. So across the board, and they are moving towards being more profitable. They have an initiative that they call Lean, Lean, which basically means they're trying to be more efficient with their operating costs. They are trying to cut general and administration and trying to work on making their R&D more efficient and things of that nature. I will mention that the company moved from a negative operating margin when it went public in 2021 to now a positive operating margin of 3.7%, which is great. Here's where it gets a little aggressive. Their target for 2028 is 20% operating margins. So they want to go in. They want to go in 2 years from 3.7 to 20% operating margins. So they talked a lot about 2028 targets during the call, and I think that kind of centers around the gas turbine backlog and whatnot. But yeah, they want to go from 3.7 to 20% operating margins in basically 2 years. So I thought that was I was a little surprised by that. That feels really aggressive to me.
Yeah, it does. And like, did they mention if it's a gross margin thing or if it's an operating leverage thing or just all the above? Like whether we
kind of all the above. I think the majority of what they're expecting the expansion to come from is pricing. As the backlog gets bigger and bigger, and more people are ordering more and more turbines, they're going to be able to charge more. And the more efficient that they get they talked a little bit about robotics. They talked a little bit about AI helping to try to make them more efficient in their production. And so if they can start squeezing the juice a little bit more, they feel like that's where they can get the margin increase, as well as trying to be a little more efficient on the operation side of it.
I will throw one more thing out there, because I got to imagine there's at least one person out there who's going to go down deep rabbit holes because of this episode, and I hope you do. To the idea of pricing power and affecting gross margins, look for our episode called Financials Demystified Gross Margins. You can search Investing for Beginners podcast on Google, pricing power margins, gross margins, something along those lines, and it should pop up. That can give you a sense of if GE Vernova does expand it through pricing, like it sounds like they are implying, that's how it could really, in my opinion, so you see in software companies, you get operating leverage from R&D or SG&A. But if they really want to hit that kind of a jump that you've talked about, which is over 10x, something like that. I don't have the TTM numbers in front of me, but that has to be so much gross margin. I don't see that would be so crazy if it was on the operating side. So I just want to throw that out there.
Yeah, that's a very, very good point. I want to touch on capital allocation real quick. One of the things that they talked about, their goal is to return 30% of cash to shareholders annually, either through a dividend, which they have been growing, and buybacks, so reducing their share count. So they've been authorized to spend up to $10 billion in share repurchases, and so that is going to be going forward one of their capital allocation metrics that they're going to be tracking, and they said that they want to be challenged on that. So that is something to kind of keep in mind. If we kind of switch over to the balance sheet quickly, one of the things that stands out really quickly is they have no debt. So they have net cash of about $8 billion on the balance sheet, and they have no debt. So that gives them a lot of financial strength. They are an investment grade rated company. So if you go to Moody's or S&P Global, you'll find that they are an investment grade, which means that if they do want to take on debt and to do any acquisitions or things of that nature, they will be able to get pretty favorable terms as far as the debt that they'll be able to raise. So that was, really, really good. So if you look at the balance sheet to me looks pretty strong, just based on that alone. So they're doing good on that part of it. And the company is generating cash flow, which is always a good thing. So it helps them fulfill those promises that they're talking about. So surprisingly, the company does generate profit, and it is generating positive operating cash flow. Their CapEx numbers are really not that big, considering they're probably I would say maybe a more capital heavy company than I would think. But their CapEx is really not much. Like, for example, last year, they didn't even spend $1 billion in CapEx, and they generated almost 3.5 in operating cash on their cash flow statement. So those bode well as they go into the future. If they can continue to generate that much cash from their operations, and to Andrew's point, if they can expand the margins even more, that gives them even more cash flow to do a lot more things if they want. So if they want to make any sort of acquisitions, increase the buybacks, all those kinds of things, it puts them in a way, way better position.
Yeah, 100%. As far as their capital allocation goes, do you have an opinion, or is it still like not a long enough track record to really have a solid conviction on?
I would say it's too early. It feels like they're probably, to use a baseball analogy, it feels like they're still in the second or third inning on a lot of this stuff, because they haven't been public for very long, and they haven't really had the ability to do some of those things quite yet. So it's interesting that they throw it out. It's interesting that they talk about it. But until I see them do it, I guess I'm going to be a little bit more hesitant to say, yeah, look, hey, this is, they're a share, they're a share cannibal company, like an AutoZone or something. Until they actually achieve that achievement, I'm going to hold reserve judgment, I guess.
Yeah, it certainly is a risk when you look at a company this young, and depending on your risk tolerance, I think that plays a factor in this. Before we move on to some of the risks for this business, was there any other numbers you want to point out? That was a pretty good summary there.
I think the thing that I probably am most interested in to see is going to be some of the return metrics as they go forward, to see how those are going to play out. Return on equity, return on invested capital, because those will start once the company is still youngish and newer to that. So really, those long-term numbers are really not great at this point. But as the company moves further and further away from its IPO and starts to generate more steady, regular profitability, I'm going to be really interested to see how like the ROIC stands out and where that sits, and especially among industrial companies like this. If they can achieve ROICs of 15-20%, that's going to be like, that's fantastic. And if they can continue to find places to reinvest that money, that's just even better. So that's what I'm looking forward to seeing.
Yeah, I mean, if you start talking about like double-digit sales growth with like a 15-20% ROIC, like my mouth starts salivating. I don't know about you.
Yeah, yeah, for sure.
Doesn't take much for me though, as a burgers and fries guy. So, but from a stock market perspective, yeah, those are great numbers. All right.
Yeah.
What kind of risks do you think investors or prospective investors should be aware of when it comes to GE Vernova?
I think probably the biggest thing is, how long is this? There's probably two risks that really kind of stand out to me. Number one is the valuation of the business. It is sky high, to say the least. It's trading at PEs of 95 to 110. I've seen a wide range over the last 4 or 5 months since I've been kind of looking at this company and interested in it. So, even if you look at like EV to sales, EV to EBIT, price to free cash flow, all those things are just really, really, really high. And so for a company that, maybe you could justify it if a company was growing at like 50% a year kind of thing. But when it's growing at 9 or 10% a year, while that's awesome, is not, one doesn't really relate to the other. Like it seems like there's a huge disconnect. And I'll use a phrase that we haven't talked about since the COVID period. There's a lot of the value. It feels like it's been pulled forward at the moment, and it's all strongly connected to the AI play, which is dominating the market and has for the last year plus, and likely will be the same story this year as well. And GE Vernova is very closely connected to that, especially with 50% of their revenue coming from the power segment, which is connected to the gas turbines, which is connected to the data centers and the hyperscalers. So as long as that story continues to drive the narrative around this company, there's going to be a huge pull forward of the value, because everybody is like, they want to participate in the growth that GE Vernova is definitely going to experience. They're going to see steady revenue growth. They're going to see steady profitability as these contracts play out. But the biggest risk is the execution. Like to say that the company is priced for perfection. If you've never heard that term before, it basically means that they have to do everything right, like exactly right. There cannot be any stumbles. They can't flub up a supply chain to get the materials they need to produce the turbines. And if that flubs up, then they delay the delivery of those turbines, which means they delay the revenue recognition, and that will cause a stumble in the company, which would cause a stumble in the stock price, because narrative right now is driving the valuation of the business. So it is priced to perfection, and it means they have to execute on everything they're doing. I'm not saying they can't, and they certainly could, and maybe they will, and I hope they will, for not only for the company, but for shareholders and us as a society. But that's an awful big risk to take, especially paying 110 PE for a company. That's really hard. And then, the other tangential risk to that is the AI play. How long is this demand going to continue? I don't think anybody really knows, and I'm not going to make a prediction on one way or the other than the fact that it continues to roll along. But at some point, you have to think that will start to abate or slow down. And when that does, how will that impact GE Vernova? And that's one of the reasons why, one of the things I do like about the company is the electrification segment is not necessarily connected 100% to the AI play. So I think that could be an offsetting benefit for the company down the road. And I guess to me, those are the two biggest risks when I think about a company like GE Vernova.
Yeah, I mean, it really makes all the sense in the world. The backlog to revenue numbers aren't, I mean, I wouldn't put them in like the same league as like Oracle, but do you kind of get some of that vibe a little bit of like?
No, I don't.
Okay.
I feel like it's different. And here's why I feel it's different. Oracle, if you looked at Oracle's numbers, just even briefly, you could see right away that they do not generate enough free cash flow on the operations of their business to come anywhere near fulfilling the contracts that they have agreed to. Not even in the same universe. It's just way out of whack. And so the only way for them to achieve the only way for them to generate the revenue that they need, or the money that they need to fulfill the contracts that they're trying to fulfill, is to take on debt or sell equity in the business. And I'm not saying that they won't be successful, but to me, that's way on a too hard pile. That's no. GE Vernova is cash free positive. They are growing the free cash flow. The revenue is going to grow. The margins are going to grow, and they are going to be able to fulfill those contracts because of the nature of how long how long dated they are, and also just the ability for the company to generate enough cash flow. They're generating cash flow while fulfilling the contracts that they're obligated for now. And
That's
so
awesome.
as those two things expand, it'll just give them more wiggle room to do more. So I definitely don't get the Oracle vibe from what they're experiencing at all.
No, it's good to know. And if you're following along at home, just to really double click on that, one number tells you everything, and that's Oracle's capital expenditures. You can compare that to the operating cash flow. Just look at their cash flow statement, and you'll see, night and day between what Vernova is doing and Oracle.
Yeah.
Awesome.
Yeah, for sure.
Real quick, I don't think we mentioned this yet. The electrification. You mentioned how you're excited about that. What makes you excited? Or I guess you kind of covered it with the whole grid idea, right? But like, we all know like AI is generating demand for electricity. Can you give a couple more examples of other things in the economy that are driving demand for electrification?
Yeah, there's a lot, but I think probably the three biggest are AI. The next would be electric vehicles. So as the demand for more electrical vehicles continues to increase, different states around the country have had different targets for clean air initiatives, California being the one that springs to mind the most. And I don't remember the numbers, but there's targets that they need to hit of electric vehicles to help them be able to achieve those. So the production of those cars, more and more people having cars in their garages, means they need more power to charge those cars. And so there's that. And then there's also just the general digitization of our economy. So as more and more people move to the cloud and operate their businesses online, as more and more of that continues to evolve and escalate, we still are early innings of that, even though it's been going on for a long time. There's, if you drive out into the country anywhere in the United States, you can easily find businesses that have not moved into that realm at all yet. So there's still a long ways to go in that. And that is going to require more and more power. And as our computers get more and more powerful, our laptops, our desktops, the things that we do at work, as all those demands are going to continue to increase. And as our grid, as I mentioned earlier, is aging and aging and aging, it just needs more updating. It needs more wires. It needs more transformers. It needs more everything. And it's so outdated that it just needs to be, we need to spend the money on the infrastructure. There's just no two ways around it. And so as those two things continue to evolve, a company like GE Vernova is going to benefit from that.
Yeah. Plus, if you've ever lived in a hurricane state like North Carolina, I'm in Raleigh. I don't get hit as bad as Wilmington does. But yeah, right. A decent sized hurricane comes around, knocks out power lines. That happens almost every year.
Yes. Yes. And, the hardening of all that infrastructure is an ongoing challenge, for man to try to build stuff strong enough that, Mother Nature can't go, yeah, okay, great. It's cute that you built this, but here, boom, knock it over. Right. So, that is going to be an ongoing, continuing battle, especially in a state like Florida, for example, which experiences probably the most hurricanes of all the states. So it's going to be an ongoing battle.
Yeah. And we've been excited about electrification for, probably since we've had Jeff from Visual Capitalist on the show. And that was at least 5 years ago. That's right. Yeah. It's a long-term thing in our opinion.
Yes, it is. Yeah. It's very much a long-term thing. And it's definitely a subject that I'm going to come back to time and time again as part of Value Spotlight, because I think there's a lot of great companies out there like GE Vernova that will be great opportunities for us to invest in the future. And GE Vernova is certainly on my watch list, and is a company that I'm going to continue to follow closely. And if it ever presents an opportunity, it will probably be something that I would consider investing in. But at this point, it's just too rich for my blood.
Yeah. Totally makes sense. I will keep an eye on my inbox. Not that I don't already, but I will keep an eye on my inbox. patience is a good thing to have in the markets, right?
Yes, it is. Yes, and I guess the last thing I'll say about that is, we come across companies all the time that you find that are fantastic businesses. A company like a GE Vernova, for example, it's a fantastic business, but sometimes it's just not the right time to buy it. And just because you don't get in early doesn't mean you can't see fantastic returns at a later date. And so you just have to be patient, and you just have to wait. And, Uncle Warren and Uncle Charlie, that was one of the things that they talked a lot about over the last 50 or 60 years, is having patience in the market, and it will reward you. You don't have to swing at every pitch, I guess is another way of saying it. Is you can wait for the pitch, you can wait for the right pitch, and you can take a swing when you're ready.
Well, that was a complete game shutout that you just threw us. So we really appreciate it. I enjoyed it. And thanks for bringing all that great research to us.
You're welcome. My pleasure. It was a lot of fun. All right. Well, that'll wrap up our bird's eye view for today. If you guys have a company you'd be interested in us taking a gander at as far as the bird's eye views, please send us a message. You can do that at einvestingforbeginners.com/newsletter, or you can do it on the Spotify app. And before we dive out today, we also need to let you know that we are running a listener survey. We mentioned at the top, so everyone who participates will get entered to a raffle for a $500 Amazon gift card. Thus, the first 100 people to respond will receive a free Investing for Beginners coffee cup and coaster set. So head over to einvestingforbeginners.com/pod survey. That's also in your show notes. Your feedback will help make the show better, and we'd appreciate you taking a few minutes to share your thoughts. Again, that's einvestingforbeginners.com/pod survey. Must be 18 or older to apply, and terms and conditions will also apply. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Until next time, see you later, and have a great day.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.